You think Washington has the Middle East under control. But today showed how quickly that story can break. For a short time, people believed the U.S. Navy had already helped an oil tanker move through the Strait of Hormuz. Energy Secretary Chris Wright posted that message online. Soon after, the post was deleted. Then the White House said no escort had actually happened. That mistake mattered because the Strait of Hormuz is one of the most important oil routes in the world, and about 1/5 of global oil and LNG flows normally pass through it. To be fair, that post was not the only reason oil moved. Reuters also reported that oil fell sharply after President Trump said the war could end sooner than many feared. So the real message is simple. The market still does not know how safe this route really is. 1 hour, people hear a calming message. The next hour, that message is gone. When that happens in the middle of a war, confidence gets weaker very fast. Now look at tomorrow. The CPI report comes out at 8:30 a.m. Eastern, and it is the report for February, not March. That means today's oil move does not directly change tomorrow's number. But it can change how people think about inflation after the report comes out. And there is one more important point. Core CPI does not include food or energy. So if oil stays high, the first pressure will show up in headline inflation, fuel, shipping, and transport costs. Later, that pressure can spread into factories, stores, and company margins. At the same time, Oracle is telling a very different story. Oracle just reported $17.2 billion in quarterly revenue. Cloud revenue reached $8.9 billion. Cloud infrastructure revenue rose 84% to $4.9 billion. Remaining performance obligations climbed to $553 billion. In simple words, large customers are still signing big long-term AI and cloud deals. Even while the physical economy faces stress, companies are still spending heavily to secure future computing power. That is why the market feels split in two. In the physical economy, higher energy costs can hurt margins. In the digital economy, AI infrastructure spending is still moving fast. That does not mean every tech stock is safe. It means the market is no longer moving as one simple story. Some businesses are dealing with higher costs and more risk. Others are still seeing strong demand and long-term contract growth. So tomorrow, watch two things. First, watch the CPI report at 8:30 a.m. Eastern. Second, watch the 10-year Treasury auction at 1 p.m. Eastern. If bond investors become more worried about inflation, yields can move higher. If yields move higher, expensive growth stocks can come under pressure very quickly. This is not financial advice. Watch costs. Watch margins. Watch where demand is still strong. I'm Wilson, and I'll see you tomorrow.